Assalamualaikum. Welcome to lecture 13 of financial reporting. This is IFRS 5, your non-current assets held for sale and discontinued operation. A small standard, but a standard which is very frequently asked in your FR exam as well as your SBR. So in this standard, we are going to go through IFRS 5. What is the objective of the standard? Then the purpose of separate presentation, non-current assets held for sale. Definition of non-current assets, classification as held for sale, measurement of non-current assets held for sale, then presentation and disclosure of it. Then the disposal group held for sale. See, in this lecture, we are going to go through three different things. First one is non-current assets held for sale. Second one is your disposal group held for sale. And the third one is discontinued operation. Okay. So definition of disposal group, measurement of disposal group, presentation of the disposal group. Next, discontinued operation. We identify the discontinued operation, we present the discontinued operation, and finally we are going to conclude with syllabus, summary and technical articles. So the main purpose is the need for IFRS 5, that is to identify non-current assets held for sale and discontinued operation, because you will present them separately from your other assets in the statement of financial position and profit and loss statement. Now, so these are the three things under IFRS 5 that we are going to deal. First, objective of IFRS 5 is to define non-current assets and disposal groups that are held for sale and provide guidance on their measurement and presentation, and define discontinued operation and also provide guidance on their presentation and disclosure in the financial statement. Now, both non-current assets held for sale and discontinued operations are present separately. They are not one, they are not present together. Okay. Now, purpose of separate presentation. The purpose of the separate presentation and disclosure according to IFRS 5 will enable the users of financial statements to evaluate the financial effect of non-current assets that is disposed, discontinued operation. So, separate presentation of these items will improve the relevance of a financial statement because users can then identify the amount that will not be present in your future financial year. For example, by presenting the non-current assets held for sale, users can understand that they are not going to contribute in the revenue generation in the future. So this will help them to predict their future financial performance and position to make the decision. Now, discontinued operations are presented in the discontinued operation category in your statement of profit and loss. Okay, according to IFRS 18, now there is a discontinued operation category also in your statement of profit and loss, which was not there under your previous IS1. So this is separate from your continuing operation. This separate presentation enhances ability of the user of financial statements to make the projections of entities' cash flow, cash generating capacity and financial position. This lecture, first we are going to deal with non-current assets held for sale, then disposal group held for sale, and finally discontinued operation. Now, definition of non-current assets. A non-current asset is any asset that does not meet the definition of a current asset. For example, your property, plant and equipment, intangible asset and investment property. All these three falls in your non-current asset. And we have separate standard for each of these three if they are not held for sale that we have covered. For property, plant and equipment, it is IS 16, intangible asset IS 38, that was the previous lecture, and in the investment property IS 40. But if they are held for sale, it is accounted according to this standard, that is IFRS 5. Classification as held for sale. A non-current asset or a disposal group is classified as held for sale if the carrying amount can be recovered by the sale rather than continuing use. This is the case if your asset is available for immediate sale in its present condition and sale is highly probable. Remember these 2 points. If these two things are present, your non-current asset will be classified as held for sale. Next, what is the meaning of abandoned asset? See, abandoned asset is not classified as held for sale because the carrying amount of abandoned asset you can recover by continuing use. So non-current assets or disposal group to be abandoned are not same as non-current assets held for sale. Okay, so the abandoned assets are You can use them till the end of the economic life, and you can close rather than selling. Immediate sell in present condition. An asset cannot be sold immediately if it cannot be classified as held for sale. If you cannot sell your asset immediately, you cannot classify it as held for sale. For example, a factory. You cannot sell a factory until the order has been complete. Therefore, you cannot classify it as held for sale. Property that will be renovated before it is sold. Also, you cannot classify as held for sale because renovation takes time. So, asset cannot be held classified as held for sale retrospectively. That means classification cannot be backdated. You can't go back and change the classification. Highly probable. The second point. A sale is highly probable when the following criteria are all met. All met. First criteria. Management has to have a commitment to sell the asset. There should be an active program to locate a buyer. Asset has to be actively marketed for sale at a price that is reasonable and reasonable in relation to its current fair value. The sale is expected to be complete within 1 year from the date of classification, and there are significant changes to the disposal plan or the withdrawal of the plan are unlikely. You're not going to change the plan. So these are the 5 points. If they are present, your sale is highly probable and it will be classified as held for sale. Any of this point is missing, your asset will not be classified as held for sale. In some cases, your sale might not be complete within 1 year. Let's say that delay is beyond the management's control, but there was sufficient evidence that management actually intended to do the sale within 12 months, but due to some reason beyond their control, they cannot do the sale within 1 year. Remember, still it will be classified as held for sale because there was evidence that management had the intention. So this will not affect your classification as held for sale. Assets that are not classified as held for sale, and if the recognition criteria are only met after your reporting date. See, if you are meeting the recognition criteria after the reporting date, your assets will not be classified as held for sale in the reporting date. However, if the criteria are met before the financial statements are authorized for issue, you have to write a note and you have to disclose the fact according to IS 10 that you have met the recognition criteria according to your IS 10, that is events after your reporting period, which we are going to cover in lecture 16. Assets acquired exclusively for disposal. Non-current assets, you can acquire them exclusively with a view to sell it later. Okay, and they are classified as held for sale at the acquisition date if sale is expected to be complete within 1 year and it is highly probable that any of the other 4 classification criteria that are not met at acquisition will be met within the 3 months of the acquisition. Now, activity 1. So, in activity 1, explain whether the following non-current assets should be classified as held for sale at 31st December 2006. So, in the first scenario, it's about GHI's management decided to sell its 50 supermarket in Germany. The shareholder has approved the decision at a meeting on 19 Jan 2007. So in the first one, it is not available for immediate sale on 31st December 2006. See, they got the permission on 19 Jan 2007. That is after the reporting year end. So at the reporting date, it was not available for immediate sale. Because management did not commit, they did not commit to sell at that date. They did not get the shareholders' approval. So the criteria to be classified as held for sale are not met, but they are met after the reporting date. So you cannot classify your assets as held for sale at 31st December 2006. But the matter should be disclosed in a note to the financial statement as a non-adjusting event after the reporting period. Now coming to the second scenario. On 16 October, they have decided, JKL's management has approved a plan to sell a factory and they have announced it publicly. And at 31st December, they have the terms have been agreed. Negotiation of the final terms are still in process. Completion of the transaction is expected sometime in the spring of 2007. So here also, you can't sell the factory until you have completed the final term. Okay, but the business was ready for immediate sale, and the sale is highly probable unless other evidence exists after the reporting date before the financial statements are authorized for issue. Therefore, this factory you can classify as held for sale at 31st December 2006. Why? Because it was there for immediate sale, the business was available, and also sale is highly probable at the reporting date. Even though the transaction took place later after the reporting year end, but evidence was there that sale will take place, and also it was in the condition also that you can immediately sell. So it has met the two criteria, therefore you can sell it and it will be classified as held for sale. Now, how do you measure a non-current assets held for sale? IFRS 5 does not apply to all the non-current assets that classified as held for sale. Okay, this following will be measured in accordance with the relevant IFRS standard if they are classified as held for sale. So even if this few assets, if they are classified as held for sale, you do not use IFRS 5 for them. One is your financial asset. We use IFRS 9 for it. Even if your financial assets are held for sale, they do not come under IFRS 5. Next is your investment property measured using fair value. You will use IS 40. And by the way, IS 40 I have covered, so you have to watch my previous lecture. Then biological asset at fair value less cost to sell. For that we are going to use IS 41, and IS 41 also I have covered. So this three asset, financial asset, investment property and biological asset, will be measured using specific standard, not IFRS 5. Other than these three, all the other non-current assets that are classified as held for sale will be dealt according to IFRS 5. Now, initial classification. So, on initial classification as held for sale, non-current assets will be measured at the lower of. See, until now, all your non-current assets, whether intangible, tangible, was measured at cost on initial measurement. Now, for non-current assets held for sale, it would be lower at carrying amount, fair value less cost to sell. Whichever is the two is lower, you have to measure at that on your initial classification. The carrying amount will be measured in accordance with the applicable IFRS standard immediately before you classify as held for sale. Now, recognition of an impairment loss. If your fair value less cost to sell is less than the carrying amount, then it is said that the asset that has been classified as held for sale has been impaired. There is an impairment loss that arises, and that impairment loss will go to your statement of profit and loss. The presentation of this loss depends on the related asset. Okay, for example, it will be presented in the operating category if your asset is property, plant and equipment or an intangible asset. And it will be an investing category. Your impairment loss will be in your investing category if your asset is an investment property. So always check which asset has been impaired. And accordingly, you will put it in the correct category, the impairment loss. Now, measurement at subsequent reporting date. So under all the other standards, whether intangible, investment or non-current PPA, you had a choice between cost value and fair value model. In IFRS 5, your non-current assets held for sale will not be depreciated because it is no longer a non-current asset. It becomes a current asset now because you are going to sell it. So you can't depreciate it, now you can amortize it between their classification until their disposal. No amortization, no depreciation. At subsequent reporting date, before you are disposing it, a non-current asset that is classified as held for sale again will be measured at the lower of its carrying amount and fair value less cost to sell. But this carrying amount, when it was originally classified as held for sale, you have to take that carrying amount. And when it comes to fair value less cost to sell, this will change. It is not the fair value less cost to sell at initial recognition. This is at the reporting date. So because this will result in the recognition of an impairment loss. Okay, it can result in impairment loss when your asset that you have measured at its previous carrying amount but fair value is now less than this. Fair value less cost to sell is less than this, then there's an impairment loss. And there would be an additional impairment loss when your asset was measured at fair value less cost to sell and your revised fair value less cost to sell is even less than that. Already you have an impairment loss because fair value less cost to sell is less than the carrying amount. Now, at the reporting date, your fair value less cost to sell is even less. So, additional impairment loss. Then, impairment loss could be reversed. When your asset measured at fair value less cost to sell as on classification is more than the fair value less cost to sell. So your fair value less cost to sell at the reporting date is more than the fair value less cost to sell on classification. Then your impairment loss will be reversed. But this reversal can only be recognized to the extent that it does not exceed your carrying amount at classification as held for sale. It cannot be more than your carrying amount that you would have recognized at the classification. Now presentation. On classification, as held for sale, a non-current asset should be transferred in the current asset classification in your statement of financial position. So from non-current, it will be move on to current asset. Total of all the non-current asset that is held for sale should be presented as a separate line item known as non-current assets held for sale. You do not need a comparative information. Okay, you don't have to restate because since classification as held for sale is reflected in the period when recognition criteria are met. So comparative information you do not need to change because at that time recognition criteria was not met. Any cumulative income or expense that are recognized in OCI that is relating to non-current assets held for sale has to be presented separately. Now, additional disclosure. The following disclosures are made when your non-current asset is held for sale. You have to describe your non-current asset, description of the fact and circumstances of the sale or expected disposal, impairment loss or reversal of the impairment loss because of applying the measurement requirement for assets held for sale. If the criteria to be classified as held for sale are no longer met, you have to disclose this in your notes. The decision to change the plan to sell your non-current asset. Why did you decide now not to sell your non-current asset? Then, what are the facts and circumstances that have led to this decision? And the effect of this decision on your results on your results of operation for the period and also prior period that is presented. Now, activity 2. So in activity 2, there are two requirements. Requirement A, describe how the classification as held for sale and the subsequent disposal should be reflected in the financial statement. B, state how your answer to A would differ if your carrying amount of the investment property is different. It's 500,000 assuming all the other factors remain the same. So now this is an investment property measured using cost model. Has a carrying amount 600,000. It is classified as held for sale and fair value less cost to sell is 550. Asset was sold for 555. So now you have to compare which is lower. So in this case, the lower amount is fair value less cost to sell. So your investment property should be written down to this value, 550,000. It is this. Because fair value less cost to sell is less than your carrying amount. And also there is an impairment loss of 50,000 because your asset was sold for 555 but your fair value less cost to sell is 550. So the difference between the two is it's the carrying amount minus fair value less cost to sell if you take. So carrying amount is 600,000, fair value less cost to sell is 550. The difference 50,000 is your impairment loss. Because your property is investment, this impairment loss of 50,000 will be recognized in the investing category in your statement of profit and loss. And your property will be transferred from non-current to current. And it will be presented as non-current assets held for sale. This is on 30th September. 2006 when you have met the criteria. But on 30th November 2006, when you are selling the asset, this is the date when you are selling the asset, there's a profit that you have made. What is the profit? Profit of 5,000. Your fair value less cost to sell is 550. You are selling it for 555. So you are selling it at a profit of 5,000. This 5,000 will be recognized again in the investing category of statement of profit and loss because it's an investment property. That's why always check what type of asset you are hailing for sell. Based on that, you can decide the gain and the loss, where which section it will go, which category. Next, part B. Now the carrying amount is 500. So now your carrying amount is less than your fair value less cost to sell. So your investment property would be at its existing carrying amount 500,000. And if it's at 500,000, compare it with the amount that you have sold. Now again you are selling it at a profit, but the profit is much higher now, 55,000. Again it will go in the investing category only. Okay, and your investment property would be transferred to current from non-current. So that's the only difference. Now activity 3, a revalued asset. Here, A, you have to explain the accounting treatment at the date classification has held for sell. B, explain the accounting treatment at the year end. Okay, so this is about an owner occupied property. Which standard will you use? IS 16, which is measured using revaluation model. On the date of classification, carrying amount is 600,000, fair value is 700, and estimated cost of selling is 10,000. Remember, whenever you are given the fair value and the estimated selling cost, separately you have to deduct this cost from the fair value. It's fair value minus selling cost, which you have to compare with the carrying amount. Then at the year end, the property remained unsold, but still it met the criteria to be classified as held for sale. The fair value was 710 and the cost to sell was 8,000. So now, if you take the difference, that is 700 minus 10, fair value less cost to sell is 690, whereas your carrying amount is 600. So you will recognize your property at 600,000, the lower. But this is at a revaluation model, IS 16 revaluation model. Okay, so immediately before you classify as held for sale, property must be revalued to its latest fair value, that is 700,000. You see the fair value is 700,000 with a credit of 100,000 recognized in other comprehensive income because it is under IS 16 revaluation surplus. Where will revaluation surplus go? In other comprehensive income. How 100,000? The difference between your carrying amount and fair value. Carrying amount is 600, fair value is 700. The difference. Then your assets fair value less cost to sell is 690. So on reclassification, your asset will be written down to this value from 700 to 690. So the difference 10,000 will then be recognized as an operating expense in your statement of profit and loss. Why operating expense? Because it's a property, it's an owner occupied property dealt under IS 16. That's why it will go in operating. In the earlier example, it was an investment property, that's why it went in the investing category. Next, part B. So at the year end, your fair value less cost to sell. Fair value was 710 and cost of sale is 8,000. Difference is 702. You see, your fair value less cost to sell increased from 690 to 702. So because it increased, your impairment loss will be reversed now. So impairment loss that you have recognized when the property was classified as held for sale must be reversed. However, the additional 2,000 gain is not recognized. Okay. How much do you recognize as operating expense? 10,000. And if you check the total, 690 and 702, the difference is 12,000. Out of that 12,000, you can only reverse up to 10,000 because only 10,000 was recognized. So that you will reverse. A reversal of impairment loss of 10,000 is recognized in the operating category. So now you will not have anything in the operating category because this that you have credited, you have recognized, now you will reverse it. And the total difference is 12,000. What about the 2,000? The additional 2,000 gain is not recognized because you only had 10,000 before impairment that you have to reverse. And there is a gain because your fair value less cost to sell increased from 690 to 702. So that additional 2,000 gain was not recognized. You can only reverse what was recognized before. Anything not recognized, you can't do anything with it. So additional 2,000 not recognized. Now from non-current assets held for sale, we are moving on to the disposal group held for sale, the second part. So definition of disposal group. IFRS 5, the criteria to classify a non-current asset held for sale also applies to disposal group held for sale. What is a disposal group? A group of assets to be disposed of collectively in a single transaction, and directly associated liabilities which will be transferred in the transaction. The assets of a disposable group may include goodwill also. So example, activity 4. This is about the disposal group. You have to explain whether the following are disposal group held for sale or not. In the first one and the second one. In the first one, on 21st December, ABC has announced the intention to sell its shares, which is contingent upon the approval of the shareholders. It seems unlikely that the approval will be granted in the near future, and also no buyer also. So in this first one, it's not a disposal group. Why? Because it is a single asset rather than the group of assets and liability. Instead, it is a non-current asset investment. So it is not classified as held for sale because shareholder approval is required before you can take any sale. In this case, it is not available for immediate sale also because you don't have the approval. Without the approval, you can't sell. So it's not available for immediate sale. You understand? And also no buyer has been identified. So in this case, it's not a disposal group. And see, they are deciding to sell their shares. It is just a single asset. They are not selling their group of assets or liability. So this is not a disposal group. Second one, DEF. DEF has entered into a contract to sell the entire delivery fleet of the vehicle. Okay, on 14 December. The asset will be transferred on 28th Jan 2007, from which day the group will outsource its delivery activity to the another company. In this case, the vehicle fleet is a disposable group because it's a collection of assets and it is sold in a single transaction. You are not selling in a series of transactions, not in installment. Together you are selling that group in one single transaction. So this you can classify as held for sale because it constitutes a group of assets that are sold in their present condition and sale is highly probable at the reporting date because you have entered into a contract. That's why you can say it's highly probable. Next, how do you measure a disposal group that has been held for sale? So on the date of classification, the carrying amount of your disposable group, you should compare it with the fair value less cost to sell of the disposal group. Same like non-current assets. The only thing is this is now disposable group, not a non-current asset. The carrying amount should reflect up-to-date measurement of each individual asset and liability in that group, determined in accordance with applicable IFRS standard. Now, allocation and recognition of an impairment loss. So, if fair value less cost to sell is less than the carrying amount, the impairment loss will be allocated to the asset of the disposable group to which IFRS measurement guidance applies in the following order. This order you have to go. Firstly to goodwill and secondly to all the other assets on a pro rata basis in relation to their carrying amount. The impairment loss is presented either in the discontinued operation category if your disposable group qualifies as a discontinued operation, or Otherwise, it will be split according to the asset to that it relates, as explained in section 2.32. So for example, if it's an investment asset, it will go in investing category. If it's a non-current asset or intangible asset, it will go in the operating category. Now, any subsequent reversal of your impairment loss is allocated to the assets of the group on a pro rata basis with the exception of goodwill. See, there is no reversal of impairment loss for goodwill, only for other assets. That also on a pro rata basis. Okay. Now, how do you present a disposable group held for sale? This is presented separately from your other assets. Okay. And assets of disposable group are presented as current assets. Liabilities of disposable group are presented as current liabilities separate from other liabilities. Your asset and liabilities cannot be offset and you cannot present them as a single amount. Remember, you should always show them separately. Now, last part is discontinued operation. Identifying discontinued operation. What is a discontinued operation? A component which either has been disposed of or is classified as held for sale, and it represents, see, these keywords are very important. In your exam you have to see whether it's a separate major line of business or a geographical area of operation which you can sell, or is a part of a single coordinated plan for its disposal, or is a subsidiary which you have acquired with view to resale. So there's three things. First, let's go through component of an entity. It's a portion of the company which can operate on its own, which raises cash flow, and you can clearly identify them from the remainder of the entity. So component of an entity that is classified as held for sale is disposable group that is held for sale, because component of entity will have so many assets and liabilities in it. So you can't say it's a non-current asset held for sale. It is a disposable group held for sale. But not all disposable group will meet the remaining criteria to be discontinued operation. Remember, disposable group can be both classified as held for sale and a discontinued operation, but not necessarily it will be a discontinued operation all the time. Why? To be classified as discontinued operation, you have to meet the remaining criteria. What are the remaining criteria? Major line of business, single coordinated activity. Okay, these are the 3 points. And with a view to resale, subsidiary with a view to resale. First, let us go through separate major line. A discontinued operation must be a separate major line of business. For example, it's a major product or service line or geographical area of operation. Determining whether a discontinued operation is major requires judgment. So the following two exhibits gives you an example of operation that have met this criterion. Now, exam advice. Discontinued operation may be examined in the context of an individual company or a group of companies. Both above exhibit will represent a disposal of a subsidiary. Now, exhibit 1. It's a component which is representing a geographical area of operation. Okay. So the following is an extract from the notes to the consolidated financial statement of First Group PLC. First Group PLC is a British multinational transport group based in Scotland. They are operating their largest intercity bus service in North America. So, under discontinued operation, the disposal of Greyhound line is a subsidiary. Therefore, they will report this as a discontinued operation. Next is Exhibit 2. So, in Exhibit 2, this is a component representing a separate major line of business. So here, let's see the notes for discontinued operation. So on so and so, the company decided a formal process aimed at divesting Reebok, which was completed with the signing of sales agreement with the Authentic Brand Group on August 12th. Due to the concrete plan to divest and the approval, the operating business have reported as discontinued operation and they will be classified as disposal group held for sale since dissolution. Now, sale of the Reebok. So it was completed on 28th Feb with the effect from 1st March 2022, the total purchase price amount to this much. So what does this say? This says that whenever there's a discontinued operation, you have to write it as a note. And also when you are selling it. So this sale, how can you verify? By looking at the purchase price, okay, in the notes. Now, identifying a discontinued operation. The next one is single coordinated plan. A discontinued operation may be disposed of as a whole or in piecemeal, but always as a part of a committed plan to discontinue the entire component. Now, presentation of the discontinued operation. So in your statement of profit and loss, how will discontinued operation look like? Okay, when an entity has a discontinued operation, IFRS 18 requires that your statement of profit and loss will include a discontinued operation category. This is present immediately before the profit for the year. Okay, so a single amount is disclosed in the discontinued operation category in your statement of profit and loss, comprising the post-tax profit or loss of discontinued operation and the post-tax gain or loss recognized on measurement to fair value less cost to sell or disposal of the assets that constitute the discontinued operation. So when you're disposing the disposal asset, the discontinued operation, you might be having a gain or a loss. And the other gain or loss could arise because when you are remeasuring to fair value less cost to sell at the year end. So that will be reported. Now, analysis of the single amount. The single amount must be analyzed in the statement of profit or loss or in the notes into revenue, expense, pre-tax profit or loss of discontinued operation, then gain and loss recognized on the measurement to fair value less cost to sell or disposal of the assets or disposal group, the related income tax expense for each discontinued operation. Okay, now if presented in the statement of profit or loss, the analysis must be presented in the discontinued operation category. Comparative information must be restated for the prior period that is presented. Now, the net cash flow. The net cash flow that attributes to operating, investing, financing activity of the discontinued operation must be presented in the financial statement, that is statement of cash flow or notes. Now, as can be seen, the income and the expenses of continuing operations, they are detailed line by line. This we know. This means your continuing and discontinuing operation has to be separated. Okay, workings will be required in your exam question. And for a group accounting question, if your entire subsidiary is disposed of and if it meets the criteria for a discontinued operation, the results are included up to the date of disposal. The detail will be covered in lecture 24. However, you still have to present as a single line item rather than consolidating the discontinued operation on a line by line basis. Now, this is how in your statement of profit and loss, this is for ABC group. You have been given for 2 years, 2001 and 2. The discontinued operation will be placed. So normally we have revenue, cost of sales, gross profit, then we have other operating income, then we deduct the expense, selling, research and development, general admin, other operating expense, and get the operating profit. Once we get the operating profit, okay, then with the operating profit, we'll be adding the other income, interest income, then interest expense we deduct, then income tax we deduct, and we get the profit from continuing operation. Once you get this, below this line you see, this is where you will write profit or loss for discontinued operation. There's an asterisk mark to this. Let's see. The required analysis of the single amount is typically shown in the notes. See, they only have given one figure. That is profit or loss for discontinued operation. But all the other figures, how you have got this profit and loss, the detail will be shown in the notes. And finally, you will be getting profit for the year. So when you're told in your exam to show extracts in your P&L for discontinued operation, you should be showing after profit from continuing operation, you will write profit or loss from discontinued operation and then profit for the year. Now, moving on to activity 5. So in activity 5, this is the information. You have revenue, expense and taxation for ABC. And Sparrow is selling division C to Hong for 60,000. The carrying amount of the net asset was 70,000. Loss on disposal will attract tax relief at 30%. Now the sale contract obliges the Sparrow to terminate the employment of certain employees, including incurring an expected termination cost of 30,000 to be paid by 31st March 2008. This has not been accounted for the year end and it will attract tax relief at 30%. You are supposed to show the above information, how it will be reflected in your financial statements of Sparrow for the year ended in accordance with IFRS 5. So let us do this. So let us draw the statement of profit and loss. Okay, statement of profit and loss. Now, first let's start with the revenue. Then we'll be having the expenses. So revenue, you can only add for A and B. Division C is sold, 230 and 195. So it is 230, 195. Then we will have to add the expenses. That is 130 and 115. 245. So operating profit. This is your operating profit. So it is simply this minus revenue minus the expenses. Then we will be having the income tax expense. So the income tax is 30 and 24. So you'll be deducting 180 minus 54, which is 126. This is profit from continuing operation. See, whenever you have a discontinued, you have to write profit from continuing operation and discontinuing separately. But when you don't have anything discontinued, you can just write profit from operation. That is enough. Now, then discontinued. So there can be profit or loss from discontinued operation. And then profit for the year. Could be loss for the year also. So now for discontinued, we need a separate working. So let's do the working. Okay, this is for discontinued operation. So we'll see. Remember, in your statement of profit and loss, you will only write one figure. Profit or loss from discontinued operation. The working will be done separately. So the revenue, the expense of division C, and the termination cost, and the loss on disposal. So first is the revenue. This is from C. Revenue is 90. The cost is 100. If you go by the sum function, loss on disposal, it's 10. And then the termination cost, they have given 30,000. So it is 30 minus 30. Okay. Then what's next? You have income tax, that is 3. So because remember, if you are having a loss, you are going to get an income tax relief. Okay. So now they are selling the division for 60,000. The carrying amount was 70,000. So Now we are going to get the overall result. So this loss on disposal, okay, this loss on disposal is not the sum function of this. This loss on disposal arises from here. Coincidentally, both are same. That is, they have sold the division for 60,000 when the carrying value was 70,000. So carrying value is more than the sale proceed. The difference 10,000, that is that loss of 10,000 here. Okay, so when we add up together the difference, it is the difference between these two. Okay, and then the minus 10 loss and the termination cost. Now you have to add up all. So we'll be using the sum function. So this is the amount. Now, because it's a loss, you don't have to pay the income. You are going to get income tax relief. So income tax relief is at 30%. Okay, so it is at 30% on this, which is minus 50. So it's an income tax relief. It would be added. So we'll be using the sum function. With the income tax relief, this is the loss. So this is the overall loss from discontinued operation. So now so you see, now we are going to write that loss from discontinued operation. And because there's a working to it, we'll show it like this. This is how you have to refer. So what is the loss? It is 35 minus 35. And then we are going to write the profit for the year. Just use the sum function. Take this to 91. So this is the profit for the year. And this is how you have to present your loss or profit from discontinued operation. Right after profit or loss from continuing operation. So this is the solution for activity 5. As you can see here, we are adding the revenue, expenses and income tax of both division A and B, but we are not taking C because C is a discontinued operation. But we are taking the C's revenue expenses under the working here. And then we are getting a loss on disposal for C because the carrying value was 70 and we are selling it for 60. And then the termination cost is 30. Since we are having a loss here, we are going to get an income tax relief at 30%. And this is the loss of 35 which we are taking here right after profit from continuing operation. And finally we are getting the profit for the year. So that's it for IFRS 5. We are under the section B of the syllabus, and 9, that is reporting financial and non-financial performance. So under this we have discussed the importance of identifying and reporting the results of discontinued operation. We have account for non-current assets held for sale. Now, so we have started this lecture by saying that IFRS 5 requires separate presentation for non-current assets held for sale and discontinued operations because it will give more relevant information. An item that is held for sale, if its carrying amount will be recovered through sale rather than its continuing use. This is the case when the asset is available for immediate sale in its present condition and sale is highly probable. Options to wound down or abandon, they are not held for sale. Any impairment loss will be recognized in profit and loss, and the category where your impairment loss will be recognized depends on the asset which is discontinued. Okay. Now, measurement of non-current asset and disposal group held for sale immediately before the classification in accordance with applicable IFRS standard. After classification and at subsequent reporting date, it would be according to IFRS 5, that is lower of carrying value and fair value less cost to sell. Assets that are held for sale are not depreciated, presented separately on a statement of financial position. Why they are not depreciated? Because now they become your current asset. If a disposal group is a group of assets and associated liabilities to be disposed of in a single transaction. Any impairment loss that relates to a disposal group will be allocated first to goodwill and then to other assets on a pro rata basis. A discontinued operation is a component which has been disposed or is classified as held for sale, and these are the further criteria needed for you to be classified as discontinued. They are: you should have a separate major line of business or a geographical area which you can discontinue, or it's a part of a single coordinated plan, or you have acquired a subsidiary with a view to resale. Discontinued operations are presented as a single amount in your statement of profit and loss and OCI. We have just seen that in the previous question, activity 5. Then a more detailed analysis is required either in the notes or in your statement of profit and loss and OCI, that is distinct from your continuing operations. Net cash flow attributable to operating, investing, financing activities of discontinued operation will be shown separately. And here we have two technical articles that you have to read on your ACCA website, that is IFRS 5 non-current assets held for sale and discontinued operation, and then property, plant and equipment part 2, revaluation and derecognition. So make sure that you read these two technical articles on your ACCA website. Thank you for watching, and I shall see you in the next lecture. Next lecture is IS 36, that is impairment of your assets. So since now we have finished all the type of assets, various type of assets, starting with IS 16, then IS 20, that is government grant, then borrowing cost IS 23, then we went through investment property IS 40, then intangible asset IS 38, and now IFRS 5 non-current assets held for sale. Now we are in a better position to go through IS 36, that is impairment.